Introduction to financial management. Financial management involves planning, organizing, directing, and controlling the financial activities of an enterprise. It applies general management principles to financial resources. The primary objective is to ensure efficient and effective utilization of funds. Primary goals of financial management. The main goal of financial management is wealth maximization to shareholders. This involves increasing the market value of the company's stock. Profit maximization is also important, but it's a short-term objective that doesn't always consider risk or long-term sustainability. Core functions of financial management. Key functions include investment decisions, financing decisions, and dividend decisions. Investment decisions relate to allocating funds into profitable assets. Financing decisions involve determining the optimal mix of debt and equity. Dividend decisions concern how much profit to distribute to shareholders versus retaining for reinvestment. Each function requires careful analysis to align with the company's strategic objectives. Role of the financial manager. The financial manager plays a crucial role in an organization's success. They are responsible for financial planning, resource allocation, and risk management. This position requires a deep understanding of financial markets and economic principles. Their responsibilities also extend to capital budgeting, working capital management, and financial forecasting. Effective financial managers contribute significantly to achieving the company's strategic goals and ensuring its long-term viability. Overview of financial markets. Financial markets are platforms where individuals and institutions trade financial securities. They facilitate the flow of capital between savers and borrowers. These markets are crucial for economic growth and stability. They enable businesses to raise capital for expansion and allow investors to grow their wealth. Understanding their structure and functions is fundamental to effective financial management. Understanding money markets. Money markets deal with short-term borrowing and lending, typically for periods of less than 1 year. They provide liquidity for financial institutions and corporations. Instruments include commercial papers, treasury bills, and certificates of deposit. Understanding capital markets. Capital markets deal with long-term funds, including stocks and bonds, with maturities typically exceeding 1 year. They enable governments and corporations to raise long-term capital for large projects. These markets are vital for long-term economic development. Primary and secondary markets. Primary markets are where new securities are issued for the first time, such as in an initial public offering, IPO. Funds from these sales go directly to the issuing company or government. Secondary markets are where existing securities are traded among investors. Examples include stock exchanges like the NYSE or NASDAQ. These markets provide liquidity for investors. Financial institutions. Commercial banks. Commercial banks are a cornerstone of the financial system. They accept deposits, provide loans, and facilitate payments. Banks play a critical role in credit creation and economic development. They offer a wide range of services, including savings accounts, checking accounts, mortgages, and business loans. Their stability is crucial for the overall financial health of a nation. Financial institutions. Non-bank entities. Non-bank financial institutions, NBFIs, include a diverse range of entities such as insurance companies, pension funds, mutual funds, and investment banks. They provide specialized financial services. NBFIs complement the banking sector by offering alternative sources of finance and investment opportunities. They contribute significantly to the depth and breadth of financial markets. Introduction to financial statements. Financial statements are formal records of the financial activities and position of a business. They provide a snapshot of a company's financial health. The 3 main statements are the income statement, balance sheet, and cash flow statement. These statements are essential for stakeholders like investors, creditors, and management to make informed decisions. They adhere to accounting standards to ensure comparability and transparency. Understanding the income statement. The income statement, also known as the profit and loss (P&L) statement, reports a company's financial performance over a specific period. It shows revenues, expenses, and ultimately net income or loss. Key components include sales revenue, cost of goods sold, operating expenses, and taxes. It helps assess a company's profitability and operational efficiency during a quarter or year. Understanding the balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It follows the accounting equation: assets equals liabilities plus equity. Assets are what the company owns, liabilities are what it owes, and equity is the residual value belonging to shareholders. It offers insights into a company's financial structure and solvency. Understanding the cash flow statement. The cash flow statement reports the cash generated and used by a company over a period. It categorizes cash flows into operating, investing, and financing activities. This statement is crucial because it shows how a company generates and uses cash, which is different from its profit. It provides insights into liquidity and solvency. Analyzing financial statements. Analyzing financial statements involves evaluating a company's performance and financial health. This process helps identify trends, strengths, and weaknesses. It's crucial for making informed business decisions. Techniques include vertical analysis, horizontal analysis, and ratio analysis. These methods allow for comparison over time and against industry benchmarks. Ratio analysis. Liquidity and solvency ratio analysis uses figures from financial statements to gain insights into a company's performance. Liquidity ratios measure a company's ability to meet short-term obligations. Solvency ratios assess a company's ability to meet its long-term financial obligations. Examples include the current ratio, quick ratio, debt-to-equity ratio, and debt ratio. Ratio analysis, profitability and efficiency. Profitability ratios measure a company's ability to generate earnings relative to its revenue, assets, or equity. Examples include net profit margin, return on assets, ROA, and return on equity, ROE. Efficiency ratios assess how effectively a company uses its assets and manages its liabilities. Examples include inventory turnover, accounts receivable turnover, and asset turnover. Importance of financial planning. Financial planning is the process of managing your money to achieve your financial goals. It involves setting objectives, analyzing current financial status, and creating strategies. Effective planning helps individuals and organizations make informed decisions about spending, saving, and investing. It provides a roadmap for future financial stability and growth. Budgeting and financial forecasting. Budgeting involves creating a detailed plan of expected income and expenses over a specific period. It acts as a control tool to monitor financial performance. Financial forecasting estimates future financial outcomes based on historical data and current trends. It helps in making proactive decisions and setting realistic goals. Working capital management. Working capital management focuses on the efficient management of current assets and current liabilities. Its goal is to maximize a company's liquidity and profitability. This involves managing cash, inventory, accounts receivable, and accounts payable. Effective working capital management ensures a business has sufficient cash flow for its daily operations. Capital budgeting decisions. Capital budgeting involves the process of evaluating potential large investments or projects. These decisions typically involve significant capital outlays and have long-term implications. Common techniques include net present value (NPV), internal rate of return (IRR), and payback period. These methods help determine if a project is financially viable and will add value to the company. Risk management in finance. Financial risk management identifies, assesses, and mitigates financial risks that could impact an organization's objectives. Risks include market risk, credit risk, liquidity risk, and operational risk. Strategies involve diversification, hedging, and insurance. Effective risk management protects assets, ensures stability, and supports sustainable growth. Sources of funds. Equity. Equity financing involves raising capital by selling ownership shares in the company. This includes common stock, preferred stock, and retained earnings. Equity does not require repayment and does not incur interest expenses. However, it dilutes ownership and can be more expensive than debt due to higher investor expectations. Sources of funds. Debt. Debt financing involves borrowing money that must be repaid, usually with interest, by a specific date. Common forms include bank loans, bonds, and lines of credit. Debt does not dilute ownership and can offer tax advantages due to interest deductibility. However, it introduces financial risk and requires regular interest payments regardless of profitability. Understanding the cost of capital. The cost of capital is the rate of return a company must earn on an investment project to maintain its market value and attract new capital. It represents the cost of financing a business. It is typically calculated as the weighted average cost of capital, WACC, which considers the proportion and cost of each capital source, such as debt and equity. A lower cost of capital is generally desirable. Dividend policy and retained earnings. Dividend policy determines how a company distributes its earnings to shareholders. It involves deciding between paying out profits as dividends or retaining them for reinvestment. Retained earnings are profits kept by the company for future growth, debt reduction, or other strategic purposes. The decision balances shareholder immediate gratification with long-term company growth.